Hi, Assalamualaikum. My name is Alya Wardah binti Ahmad Bagiya. Today's video presentation, we are going to understanding capital structure. What is capital structure? Capital structure refers to how a company finances its operation and grows by using different sources of funds such as debt and equity. Okay, let's say Imagine Technology Innovation Incorporation, which has 2 million in debt and 5 million in total asset. Their capital structure would be 40%. This means 40% of Technology Innovation Incorporation assets are financed by debt. How to determine optimal capital structure? Optimal capital structure involves finding the right balance between debt and equity to minimize the cost of capital and maximum shareholder value. The formula for weighted average cost of capital, WACC, helps in this determination. Suppose Technology Innovation Incorporation has a cost of equity of 12%, cost of debt of 6%, and a tax rate of 25%. If their equity is valued at 3 million and debt at 2 million, the WACC are 9%. This calculation helps Technology Innovation Incorporation determine their optimal capital structure for minimizing WACC. Factors affecting capital structure decision. There are several factors influence capital structure decision. Let's say company C in a high growth technology sector may prioritize equity financing to retain flexibility and reassure investors about its growth prospect despite higher costs compared to debt financing. Here are some factors that a company will consider. First is business risk. One of the primary factors influencing capital structure decision is business risk. Companies operating in volatile industry such as technologies or commodities may prefer a conservative approach with lower leverage. Second is financial flexibility. Financial flexibility refers to a company's ability to raise capital quickly and at a reasonable cost. Now, let's move to the financial distress. Financial distress can occur when a company cannot meet its debt obligation. An example is Company D, which took on excessive debt to expand rapidly but faces cash flow problem during an economic downturn, leading to bankruptcy restructuring. There are several common causes of financial distress that companies may encounter. First, high debt levels. Companies with excessive debt may struggle to generate sufficient cash flow to meet interest payment and principal repayments. Second is declining cash flow. A decrease in revenues or profitability can strain liquidity, making it challenging to fund operation and debt obligations. Now we're going to discuss the integration of tax effect and financial cost of distress. The integration of tax effect and financial cost of distress is crucial in capital structure decision. The formula for calculating the interest tax shield is interest tax shield equal to debt times tax rate. For example, if Technology Innovation Incorporation has 2 million in debt and a tax rate of 25%, the interest tax shield is 500,000. This tax shield reduce their taxable income, thereby lowering their overall tax burden. Agency cost of equity. The agency cost of equity arises when management prioritize their interest over shareholders. Let's say Company F, facing a decline in stock price due to poor earnings, issues additional shares to raise capital and diluting existing shareholder. There are several types of agency costs associated with equity. First, managerial compensation. Excessive executive compensation packages that are not aligned with company performance can lead to agency costs. Second is empire building. Managers may engage in empire building by pursuing mergers and acquisitions that increase the size of their department even if these actions do not create shareholder value. Pecking order theory. The pecking order theory proposed by economists Myers and Marshloof in 1984 suggests that companies have a preferred hierarchy or financing sources. According to this theory, companies prioritize financing sources in the following order. First, internal financing, debt financing, equity financing. Several companies have exemplified the principle of the pecking order theory, such as Google. In its early years, Google relied heavily on internal cash flow to fund its rapid expansion and innovation projects. This approach allowed Google to maintain control over its operation and avoid the issuance of debt or equity until later stages when it sought capital for later strategic initiatives. Now, signaling hypothesis. The signaling hypothesis suggests that companies use certain financial action or signals to convey private information about their true value, profitability, or future prospect to investors and the market. These signals are intended to reduce information asymmetry between management and external shareholders, thereby influencing investor perception and the company's stock price. And the type of signal are dividend policy. Companies that consistently increase dividends signal financial stability and confidence in future cash flow. Second is share repurchases. Share repurchases indicate that management believes the stock is undervalued, signaling positive future prospect. Third is debt issuance. Issuing debt can signal confidence in the company's ability to generate future cash flow to cover interest payment. The conclusion are capital structure decisions are critical for companies to achieve optimal financing and maximize shareholder value. By understanding factors like financial distress, tax effect, agency costs, and signaling, company can navigate challenges and leverage opportunities effectively. That's all. Thank you from me. I hope this video has provided valuable insight into this important topic in corporate finance.